This video will deal with consolidated financial statements using the partial equity method with upstream sales. This problem 6.8 in your text will be used as the example to highlight this technique. The consolidated financial statements working paper's partial equity method. You should note that the balances reported by the parent company in income, retained earnings, and the investment account differ depending on the method used by the parent company to record its investment. Recall, there are three methods that the company can use. 1. The cost method, 2. The partial equity method, and 3. The complete equity method. However, the method used by the parent company to record its investment has no effect on the consolidated balances. In this video, we will be looking at the partial equity method. Problem 6.13. Prac Corporation owns 90% of the common stock of Seagull Company. The stock was purchased for $810,000 on January 1, 2012, when Seagull Company retained earnings were $150,000. During the course of the year, there were some entries relating to the purchase and sale of inventory that would have been considered intercompany. And in this example, we will be preparing the worksheet entries and the consolidated financial statements for the year ended December 31st, 2016, remembering that the company was acquired on January 1, 2012. Again, consolidated financial statements subsequent to acquisition. In this question, we would note you have the income statement, statement of retained earnings for the parent company Prac and the subsidiary Seagull. We also have the balance sheet for the parent company Prac, which shows investment in Seagull at $847,125. Now you would note that the company was acquired for $810,000. This adjustment in the investment account has been as a result of the changes in equity over the years using the partial equity method. Under the partial equity method, you will also note the income equity in Seagull's income of $64,125, which would represent 90% of the net income of Seagull, because the company acquired 90%. So in calculating 90% of $71,250 would result in $64,125 that would have been recorded in the parent company as their equity in Seagull. This is how we know the company is using the partial equity method. Having completed the income statement, statement of retained earnings, and balance sheets for the parent and the sub, we now move to deal with the substantive issues. You would have noted, I said earlier, the subsidiary income of $71,250 multiplied by the parent share of 90% give us $64,125. Now our first job is we have to reverse the effect of the parent's entries for the subsidiary's dividends and income. In doing so, we would debit the equity in subsidiary income with $64,125. We would credit the investment account with $10,125 and dividends declared $54,000. In other words, we would have eliminated the equity in subsidiary. We would eliminate the dividends declared and the difference. Now this is a compound journal entry. Alternatively, you could debit the equity in subsidiary account $64,125 and debit the investment account, and credit the investment account with $64,125. Then you would debit the investment account with $54,000 and credit dividends declared. Or, as is shown here, a compound journal entry would suffice. So we go to the worksheet and we make a debit in the equity in subsidiary income, this would eliminate this amount here of 64,125. We would eliminate the dividends declared by the sub. We are going to credit 54,000, which represents 90% of 60,000. The other 6,000 goes to the NCI. And the difference between 64,125 and 54,000 would be recorded in the investment account as a credit. So your investment account is now readjusted to reflect the beginning of the year balance in the investment account. Now we turn our attention to how we deal with sales. And in this example, we're looking at upstream sales. This is sales being made by the sub to the parent. So on January 1, 2016, Prac Corporation had inventory of 45,000 that had been recorded by Seagulls Company's 2015 sales. During 2016, Seagull Company made intercompany sales of 300,000 with a markup of 20% of the selling price, and at the end of the year, we had in stock $75,000. So to calculate our inventory, we note intercompany sales of 300,000. In total, a markup of 20% will give us 60,000 in profit. We know that of this amount, we had 75,000 on hand at the end of the year, thus suggesting that we sold 225,000, and we make the necessary 20% calculations here, which would indicate that our gross profit total of 60, or unrealized profit in ending inventory, is 15,000, and we would make the necessary adjustment by eliminating the intercompany sales by debiting the sales account with 300,000 and crediting our cost of sales with 300,000. This will eliminate the intercompany sales. We will then debit the ending inventory in the cost of sales section of the income statement, and we would credit the inventory account on the balance sheet with the 50,000. This entry is to reduce the inventory from 75,000 that is currently shown on the balance sheet and included in the cost of sales of the parent, to reduce it to 60,000, which would represent the value of the inventory from outsiders. These entries would eliminate the intercompany sales and defer the unrealized profit in ending inventory. With respect to the beginning inventory, we would now have 45,000 that was deferred in 2015 that would now be realized in 2016. To do this, we will make an entry of debiting the parent's retained earnings with 90% of that 45,000, because these are upstream sales. So 10% belongs to the NCI. So 10% of the 45,000 belongs to the NCI, and that would be debited to the NCI's account, and the beginning inventory in the income statement will be credited for the $45,000. So that entry is to realize or recognize the gross profit in inventory that was deferred in the prior period, and to reduce the consolidated income of the parent and the NCI for their share of unrealized profits at the beginning of the year. So you would note here now your entries. The sales have been reduced by debiting 300, crediting the cost of goods sold. Next, we have the ending inventory. Here, 45,000 is its total, 40,000 going to the retained earnings of the parent, which is Prac, to realize this is in the beginning inventory, and the NCI getting their share. Then we would reduce the inventory on the balance sheet. So the 75,000 would have been included in this 172,500. This is credit here would reduce it by 15,000. Likewise, the adjustment would have been made in the cost of goods sold account to reduce this 517,500. Sorry, this 1290 by 15,000. So these represent the entries that would be made in your worksheet to eliminate the intercompany sales and purchases. Next, we would eliminate the investment account and create the NCI account. So we would debit the beginning retained earnings with 180,000. We would debit the common stock 750,000, and we would credit the investment account with 837,000 and the non-controlling interest with the 93,000. Note that your investment account is now 837. It was 847,125, but when we credited the 10,125, the effect of subtracting this 10 from this 847,125 gives us a balance in the investment account of 837. We'd eliminate the common stock of the sub with the 750, and we go to the beginning retained earnings of the sub and we eliminate this 180,000 here. The other entry you notice will go to the NCI, which is effectively the balancing figure, or the NCI's share of the investment account when we take their 10% in equity. So those entries will in fact would have eliminated the investment account and the corresponding equity accounts. Having completed that elimination, we go through the process of doing our consolidations. Now please note that the non-controlling interest in the consolidating income would be the 71,250, which is the unadjusted net income, and then we make the necessary adjustment for our beginning inventory profits and our deferred profit here from our net income. So 10% of this would result in the NCI share of consolidated income of being 10,125, which is their share. So it is 10% of this, but we have to make the necessary adjustment for our inventory balances. The 45,000 from which is deferred from our 2016 inventory, and the 15,000 now that would be, sorry, this is the 15,000 that is deferred and the 45,000 that is recognized. And we go through the process of doing our totals in our income statement, making the necessary adjustments, and therefore we will be able to compute our consolidated balances. We will total the columns, the respective columns, and when we total here, we will transfer this entire line to the net income line in the retained earnings statement. Then we total these columns, and we will transfer the closing retained earnings line to the retained earnings line in the income statement. Having made that transfer, we go through the process of completing our consolidated balances, where we are making our necessary adjustment to the respective accounts for PRAC and SIGAL. And we would have made our calculation here for our NCI, and therefore our NCI's balance is now 92,625,000. So what we should note in terms of analyzing our consolidated net income, under the partial equity, it is basically the same as the cost method.